Hi, my name is Brooke Ennis, and this is a presentation on the financial statement analysis and ratios for the company Zoetis Inc. for year-end 2017. This presentation is going to be from management's perspective, and over the next few slides, we will go over kind of a company overview, obviously the analysis of the financial statement, and then a comparison to some of their top competitors, and of course the industry as a whole. And then we'll sum it up with a little bit of a conclusion and insights to the future of Zoetis. So on the first slide, this is an introduction to the company. Zoetis was founded in 1952, and they are still known today as one of the world's largest producers of medicine and vaccinations for animals. They have pioneered over 300 products within 5 product categories, all for 8 different animal species. Some of their pharmaceutical competitors would be Eli Lilly and Novartis, which is important to note because you'll hear them again in the presentation. They have won numerous awards and recognitions over the years. Some of the most important ones to note would be that they made the list 3 times for America's Best Employers for Forbes magazine. They were also named the best company to work for in multiple different countries, since they do have a presence in over 100 countries. To begin with the analysis, we'll start with their gross profit margin for 2017, which was 66.55%. This is a measurement of how well they're operating as a company, how well they sell their products, and of course, how well they monitor their expenses. They experienced a 1% increase from the prior year and in 2016. The gross profit margin is just simply the gross profit divided by their net sales for the year. And that gross profit actually was $3,532,000,000 for 2017 alone. So with that being said, the net profit margin for 2017 came out to 16.28%. The net profit did experience a slight decrease from year-end 2016, but they still stayed above the industry average. The operating profit margin for 2017 came out to 32.15%. That is also going to be the operating profits divided by the net sales. So the operating expenses for the year of 2017 were $1,826,000,000 for the year alone. To continue the analysis, the return on investments, ROI, or also known as return on assets, was greater than 10%. However, they did experience a decrease from year-end 2016, a little less than 1% decrease. The ROI, which is going to be their net earnings divided by total assets, indicates the amount of profit that they earned for the year for 2017 relative to their level of investment in total assets for the year. And so from that, their return on equity came out to 48.38% for 2017. Again, the return on equity is going to be their net earnings divided by the stockholder equity. They did experience almost a 7% decrease from the year in 2016. Both of these measurements, the ROI and the return on equity, are going to measure the efficiency of the company in managing their total investments in assets and obviously in generating return to their shareholders. So it's important to note that they did experience a decrease in both of these from 2016 to the year of 2017. So the 2017 net income for Zoetis came out to $864 million. It's also important to note that they experienced a $43 million increase from year 2016. This also was a 5% increase to their bottom line. And the net income really just represents the profit after the consideration of all of those revenue and expenses for the year. So to continue, that brings their current ratio for year 2017 to 3.85. This simply shows how many times their current assets for 2017 can cover their current liabilities for the same year. So that shows that, their ability to meet debt requirements as they come due would be almost 4 times in 2017. Their debt ratio actually came out to 79%, and that really is going to show you the portion of the assets that are financed with debt for the year. So out of all of their assets for 2017, almost 80% were financed with debt, which isn't always a positive thing. 80% of your assets relying on the amount of debt that the company has is simply what that states. The 2017 debt to equity ratio came out to 3.81, so almost 4. However, there was a slight decrease from year-end 2016. And the debt to equity ratio compares really the total liabilities to the shareholders' equity. So from words of Investopedia, this really is going to be a measurement of the percentage from the balance sheet in this financial statement that's financed by suppliers or creditors, maybe lenders, versus what the shareholders have committed for the year. So to move forward into more of an industry comparison, we already stated that the gross profit margin for Zoetis was 66.85%. It was significantly higher than the industry median for 2017, which came out to a little over 50%. Same with the net profit margin. Theirs was 16.28% for 2017, compared to the industry, which was only 0.86% average for the industry as a whole. Their ROI, again, was a little over 10%, which compared to the industry median was significantly higher. The industry median was negative 2.24% for 2017. If you compare that to their top competitors that we've already mentioned, Eli Lilly only had an ROI of 5.52% for 2017, and Novartis had a little under 5% for 2017. So it is important to note that the ROI for Zoetis was nearly double their competitors. To continue the comparison between the industry and Zoetis, their return on equity that we looked at already was almost 58%, and that industry median came out to 0. So when you compare that really to their top competitors, Eli Lilly only had a return on equity at 14.6%, and Novartis only had a return on equity of a little over 9%. So the return on equity for Zoetis, again, is significantly higher than their top competitors. The debt to equity ratio that we looked at was 3.81, and that compared to the industry median was not even a full 1%. It was 0.06. So when you look at their competitors, they're also below 1. And so Zoetis compared to their competitors is 3 times what their competitors and the industry median was for debt to equity. Again, the debt to equity was comparing the total liabilities to the shareholders' equity for the year. So in conclusion, Zoetis did have a strong year in 2017, but that doesn't mean there's not room for improvement. Their debt is high, but it is important to note that it's decreasing year over year. They had a decrease in operating cost, which is always positive. Their current liabilities are also decreasing. So maybe considering inventories are down and that is the main source of income, maybe it's time for a new product or to branch into a new product line or even a new animal species, but they have to keep an eye on that debt when doing so.